there's a bunch of different instruments you can trade, okay, and they're all kind of priced similar. You know, like the tick movements, they might be different numbers and different denominations, but they really kind of work out the same in a lot of ways. But there are some other major differences that you want to be aware of, and really what it is it's the emotional drive that the market, how it affects you. Okay, so you know, one of the easiest ways to talk about this is compare the NQ to the ES to the Russell. Okay, so the NQ, the Nasdaq, to the S&P to the Russell, and the Nasdaq, the tick value, okay, each one of these tick movements is worth $5. Okay, $5. It's $20 a point. And that's what we trade all day long, $20 a point. The S&P is $12.50, okay? And that works out to $50 a point. And the Russell, which is a much different market altogether, but they do have an E-mini version, is $100 a point. So there's a difference in the tick value. Now, you know, the overall values might be the same, but there's a lot more movement in the Russell than there is the Nasdaq, and there's a lot more movement in the Nasdaq than there is in the S&P. Even though they look very similar on charts, you see these different movements, and it is definitely a different trading atmosphere. Okay, so I'm going to compare the S&P to the Nasdaq. So let's say that you're out here and you're trading, and you're just starting to understand this, you're getting good at it, but you still have a lot of doubt in your mind, okay? And it's tough to follow the rules, okay? Everybody wants to follow the rules, but you see an advantage and you think that this is your opportunity to get rich quick, and you do it. You let the trade run. Or you see yourself getting into a profit area and you had a lot of losses and you want to try and make it up, and you jump out quick. So you start bending the rules or breaking the rules, whatever suits your needs at the time. Sometimes it's because you're scared, okay, and you do that. So one of the important things about learning to trade is learning to follow the rules regardless. It's just critical that you have a set of rules, they're written down, and you don't change them. You don't make money trading on the fly, okay? You'll never make money if you see the price go up and you jump in and you wait till it turns around. Okay, you can't do that. It's called chasing price. It'll never work. You have to have a plan. It has to be written down in front of you. You have to understand it, and you have to do the same thing over and over and over again. So here we are trading the Nasdaq, and it's $5 a tick. And it's not peanuts, okay? But it's not that much. If you lose a couple ticks here, a couple ticks there, it's a few dollars. It's not a big deal. It's maybe the equivalent of the penny slots, okay? It's not like you're losing hundreds and hundreds of dollars. But let's say you're trading the ES. The ES is 2.5 times the value. So it's $12.50 a tick. So if you lose, 3 or 4 ticks, you're $50. Now you're a meal. Okay, before you might have been a meal at McDonald's. Now you're a meal at a medium-sized restaurant, maybe even a nicer restaurant, for one person, or maybe a meal you and your girlfriend at a decent restaurant, or wife. So that's the difference. And when the chips start going against you, okay, a trade starts going the wrong way, even though you're not supposed to be out, you might tend to make a decision based on those facts, okay? You're going to get a little nervous. Maybe you're trading 2 contracts or 3 contracts. And, our target is, our exit is 12 ticks. So on the NASDAQ, that's $60. That's a fair bit of money, but that's the worst case scenario. Well, if you're trading the S&P, it's $150 with the same the same ratios that we're using. Okay, so every time a trade goes against you, it's $150 for one contract. So let's say you lose 3 in a row on the NASDAQ. You've lost $180. Let's say you lose 3 in a row on the S&P. You've lost $450. Well, I'm down 180 in one hand, I'm down to 450 in the other, and I'm still trading, right? I know that the winners are coming because I've been trading this system forever, and I know after 3 or 4 losers, you know, I'm going to be bound to have, you know, 20 winners. I mean, it's very rare you get more than 3 losers, but if you do, you know those winners are coming. But if I'm down $450 on one contract, I might be a little nervous about giving away another 150, getting up to 600. And God forbid I was trading 10, right? So you're down 4,500 and you're risking another 1,500. But on the other side of the coin, on the NASDAQ, you're only down $180. You could deal with another loss. That puts you down 240. You probably would never see that, but it could happen. You're down $240. Is it the end of the world? No. Is it bad? Yeah. Are you going to come back from it? Yeah. But if you're nervous and you're not willing to take the risk and follow the system, then what happens? So you see where I'm getting at with this? The NASDAQ is much easier to stomach, especially as a newer trader. When you get better, you can make those decisions, you know, and you can always go back to the NASDAQ. But at the beginning, it's such a great market to learn, it's such a great market to trade, and it's profitable. And you'll find that no matter what market you go to, the numbers are really the same. Okay, it's just the risk factor that's built into it. You in theory have the potential to make more on the S&P because the market is worth a lot more, and when it moves, the overall values are higher. That doesn't necessarily mean that you can make more. You can make just as much on the NASDAQ. Most of it has to do with your strategies. If you're a swing trader and you let trades go much more than you would normally with scalps, you know, it doesn't matter what market you're on. In fact, let's do this. Let's open up an S&P chart. Let me see if I have one close by. Okay, so at 445, let's say there's a low down here, 440, you got into a long trade, and you let it run from 97, 75 up to there's the high, and it's right about there. It's a 13-point trade. Okay. Now let's say, I'm going to move this over here. What time was that? That was at 440. Okay, I'm sorry, at 240. Here's the low right here. Okay, and see, on the NASDAQ, that same movement was 41 points. On the Dow, it was 13 points. I mean, on the S&P, it was 13 points. So take that 13 times $50, because that's what it is, okay? And you come up with $650. Take that 41, okay, 41.25 times 20, and you get $825. See that? They're very similar. Okay, but the NASDAQ even worked out to be a little higher. There was a little bit more movement on that. So what you're seeing is more risk because we're trading for ticks, not dollar amounts. Okay, and that's how most things work. You know, most people don't trade for dollar amounts; they trade for movements in ratios. Okay, so the same swing high created 650 on the S&P. It created 825 on the Nasdaq. Interesting, huh? The S&P's got a higher value. Okay. So when somebody says, I want to trade the S&P because I want to make more money, maybe they don't exactly understand. Okay. Or maybe they're not comparing apples to apples, and they have a friend that told them, you know, oh, you can make a lot of money on the S&P, and the Nasdaq's just dinky. So not really the case. It's more about the system you're trading and how it's set up to work.